In finance, the word leverage refers to amount of fixed cost business is having. Now there are two types of cost associated with the business. One is variable cost and other one is fixed cost. First, let's talk about variable cost. Variable cost tends to vary with your sales activity. If your sales increase, variable cost will also increase. If your sales decrease, variable cost will also decrease. Now the example of variable cost can be raw material, and another it can be wages. If you are producing more number of units, you will consume more raw material and you have to pay more wages to your laborers. So your raw materials and wages cost will also rise. Now variable cost have a direct relation with sales. If your sales increase by, let's say, 10%, variable cost will also increase by 10%. On the other hand, let's say if your sales drop by 5%, variable cost will also drop by 5%. So remember this, variable cost have direct relation with sales. Now let's talk about fixed cost. As the name is, fixed cost remain fixed irrespective of your sales activity. Whether your sales increase or decrease, fixed costs are going to remain same, that is fixed. Now example of fixed cost can be monthly rent payment of your office or factory premises. Let's say you have rented a premises where you are doing a business, so you have to pay fixed monthly rent payments. So this will be classified as fixed cost. Another example of fixed cost can be salaries which you pay to your employees. So salaries, at least in short term, is classified as fixed cost. Now we can further divide this fixed cost into two parts. One is operating fixed cost, another one is financing fixed cost. So this is operating fixed cost and another one is financing fixed cost. First let's talk about operating fixed cost. Example which I have given of monthly rent payments or salaries, these examples can be classified as operating fixed cost. Operating fixed cost means your business cost or your business expenses. So monthly rent payment and salaries are your business expenses, so we can classify them as under operating fixed cost. Financing fixed cost comes into a picture when you have taken debt in the business. Let's say to expand the business, you have taken a loan of rupees 1 lakh at 10% per annum interest. Now every year you have to pay 10,000 rupees as interest. So this 10,000 rupees, which is the interest cost, is classified as financing fixed cost. So there are two types of fixed cost in the business: operating fixed cost and financing fixed cost. Operating fixed cost are your business expenses and financing fixed cost is your interest expense. And if you are debt free company, there is no fixed financing cost in the business. But if you have taken debt in your business, then your business will also have a financing cost. Higher the fixed cost, higher will be the leverage in the business. This is the important point you have to remember. If fixed costs are very high, there will be high leverage in the business. If business is having operating fixed cost, then there will be operating leverage in the business. I repeat, if business is having operating fixed cost, then there will be operating leverage in the business. On the other hand, if business is having financing fixed cost, then there will be financial leverage in the business. And if we combine these two leverages, that is operating leverage and financial leverage, then we will get combined leverage. So these are the three leverages which we will study in detail in this topic. One is operating leverage, another one is financial leverage, and if we combine these two leverages we will get combined leverage. If there is high amount of operating fixed cost in the business, there will be high operating leverage, and if there is high amount of financing fixed cost in the business, there will be high financial leverage. High operating leverage along with high financial leverage will give you high combined leverage. Now it is generally said that if one leverage is high, another leverage should be low in order to balance out. As I mentioned, higher the fixed cost in the business, higher will be the leverage, and it is considered as risky situation. Because as a business, you will make profits only once you have recovered all your cost. If there are high fixed cost in the business, and if sudden economic downturn happens, let's say recession hit the economy, then your business will suffer, your sales will fall, and if your sales fall, you won't be able to recover your fixed cost. So as a business, you will start making losses.